And today we want to talk about the risks of investing in ETFs or exchange-traded funds.
Well, let's start with an example, Peter. What is an ETF?
Yeah, the example that I use when people ask me, Paul, is an exchange-traded fund gives you a chance to buy an index like the ASX 200 index. And it means you get Australia's top 200 companies on the stock market, all in one trade. And I think people like that. The idea is you're coming home from work, you turn on the radio, the market's up 2%, you've made approximately 2%.
Well, that's a good example. Let's just talk a bit more specifically about some of the characteristics of ETFs.
Yep.
First of all, they are open-ended investment funds that are listed on the ASX. Open-ended means that they can go up in size or go down in size depending on the buyers and sellers. So that's an important characteristic.
Yep.
They're usually designed to closely track an index, such as the ASX 200, the example you gave, or a commodity such as gold. They actually invest in the underlying securities that make up that index.
So they buy those actual stocks?
So you said the ASX 200, the ETF will buy those 200 stocks that make it up.
Yep.
Open-ended, as I said, usually low cost, pretty transparent because the ETFs also disclose on their website all their holdings, so you can see exactly what the fund owns. And they're usually pretty liquid. They employ market makers to make sure there's good bid and offer price, and you should be able to get in and out at fair value.
Okay, so let's talk about the various types of ETFs out there.
Well, there are two broad categories. There are the passively managed, and this is the biggest category of ETFs. In other words, they actually track an index.
Yep.
There are also some actively managed ETFs, and they're sort of a bit newer, Peter, but let's deal with them, the passively managed type. Number of different types of ETFs. So the first one are ETFs that track broad asset classes. So you can get an ETF on shares, we've described. There are ETFs that cover the fixed income market. There are ETFs that cover commodities like gold. You can get local or international ETFs for the Australian market or international stock market. So you want to invest in the US, you can buy an ETF that tracks the major US stocks, for example. They have broad market or component ETFs. So we talked about a broad market ETF like the ASX 200 or the ASX 300, but you can also get an ETF that tracks small cap stocks, and that's a way to get set in the lesser part of the market, if I can say that.
Yep.
There are ETFs around sectors. So healthcare and IT have ETFs. There are also thematic ETFs, Peter, that offer things like high yield or track high yield stocks or things like robotics. So lots of different types of ETFs.
And I love some of the ticker codes that are coming up, and with the robotics one, Robo, I think is a fantastic one.
They get very creative, the guys who put, guys and girls who put these ETFs.
The gold one is gold.
Yeah, who put these ETFs together.
Yeah. So actively managed, Paul. Talk about that for a minute. Yeah,
so the newer type of ETF are actively managed. In other words, this is where the manager is actually making decisions about the stock. They use exactly the same structure as an ETF and sometimes come under different names. This is growing in the market, but typically when most people think of ETFs, they think about index tracking passively managed stocks.
Yeah, but the active ones could be for specific areas, like this ETF might go looking for the best income stocks, and you can't get that in an index. You have to have some kind of decision process.
That's right, Peter.
Okay, so let's look at the risk, Paul.
Well, of course, the major risk remains to the underlying assets. So if you're buying an ETF tracking the ASX 200, you're exposed to the share market, right?
Exactly.
That's the biggest risk. But there are some specific risks that apply to some ETFs, which is just worth sort of outlining. First of all, are the underlying assets real or synthetic? So an example of that, Peter, is you can have an ETF that actually invests in physical gold. You can have an ETF that actually invests in gold futures, that is futures on gold.
And that's synthetic.
And that's synthetic, and that's taking it to an extra dimension. So arguably that's a little bit riskier than an ETF that actually just owns the gold. So synthetic or real assets, I think that's an important distinction. Most ETFs in Australia are actually invested in real assets, so you don't need to worry about it too much. But it's just
It's a key question.
It's a key question, and sometimes if this market grows, we're probably likely to see more synthetic ETFs come into it. Secondly, is the index what I've described as official and widely used as a benchmark? Now, in some parts of the market, indices don't exist or they're not widely recognised. So in some cases, the issuers have had to construct their own index. That means potentially there could be a few more challenges if the market gets into trouble because maybe the stocks aren't as liquid and as perhaps...
And there's less history.
There's less history to go by. So it's important to actually look at the actual type of index that's being used.
Yep.
Liquidity is a really big factor with ETFs, and liquidity is about how easy it is to exit when you want to at fair value. Can usually be pretty good to exit, but is it a fair market price to exit? And so typically the bigger ETFs with a lot more market makers, they have a lot more liquidity, and so that's a consideration. And finally, as it comes into any product, and remember, ETFs are a product, the manager's standing and the manager's credibility.
And one thing I should throw in there for people wondering, you said fair value. How do you work out what fair value is?
Most of the ETFs will publish what they call an INAV, or indicative net asset value. So that's actually valuing their assets in real time to tell you what the ETF should be trading at. So you can actually compare where it's physically trading at on the ASX compared to what the manager thinks it's the underlying value really is.
So you don't have those discount and premium issues like you would.
You shouldn't have the same sort of
investment
discount
company.
and premium issue that you might have with a listed investment company.
Okay, so what should you consider when choosing an ETF?
Okay, firstly, the underlying index, right? If you want to, if a good example is the Australian share market, you've got ETFs that have track, for example, the ASX 200. That's a pretty broad index. You have an ETF that tracks the ASX 300. So if you want to get a broad market exposure to the broad market, look at an ETF for the 200 or the 300. Don't look at an ETF that might track just the top 20 stocks, right? And
unless you want the top 20.
Unless you just want the top 20 stocks. So the underlying index is really important. Real or synthetic, I think we mentioned.
Yeah.
Who is the manager? That's always an important consideration in any investment.
Yep.
What's the management fee? Because these things are now getting super competitive, and so and they're very transparent about the management fees. So remember, with your return for an ETF that tracks an index, you should be expecting to get the index return less the management fee. So the management fee can still be important. And finally, I think size of the ETF and track record of the ETF can still be relevant considerations. Generally, the bigger the size, the longer it's been around, the better the liquidity should be. So look, and again, if you're investing in an ETF that's just getting off the ground, you might just want to be a little more circumspect about doing that. So they are all considerations when trying to consider which ETF is right for you.
I've got to say, Paul, I do like ETFs, and I tend to use them, and in particular I buy the ASX 200 index whenever there's been a big sell-off of the market, and I'm not sure if I got one company or two companies I like, I buy the index on the basis that I think there's going to be a rebound, and sometimes I've picked up a 10% gain, plus picked up 4% or so for dividends, a 14% gain just paying the best 200 companies in the country.